Hey David, welcome to the dive.
Hey, thanks for having me.
Okay, so let's start with the 2 minute elevator pitch for XOUT Capital.
So, really quickly, this is so simple. There are three insights that drive what's behind XOUT. Insight number one is flows are continuing to dominate into passive index strategies. Insight number two is it's easier to eliminate the losers than to pick the winners. And insight number three is technological change is disrupting all companies across all industries. And XOUT seeks to address all of those three insights by offering investors, in this case, a large cap U.S. equity market, an ability to not own those companies in the S&P 500 that are being disrupted or will be disrupted by technological change.
So, what are the key metrics you use to assess companies?
So we're sort of smarter beta, I like to say. We use seven fundamental factors that each one of those seven factors, and I'll get into them, provide a score. We score all 500 of the largest US market cap companies, and then we eliminate the bottom 250. So we use things like revenue growth, labor hiring, how an analyst thinks about the company and how they perform against analyst estimates. What's a management team doing? Are the companies investing in research and development? Are the companies investing in their own stock? And we take each of those factors, we score them, and as I said, take out the bottom 250.
So, let's talk about the fund's largest holding, Apple. Why would Apple rate high on your criteria?
But believe it or not, I mean, Apple's is as great a company as everybody, I think, generally believes that it is. It's hard to find someone who just hates Apple. But it's
Mhm.
maybe, and some people might argue it's expensive, but it just continues to outperform each and every quarter, quarter over quarter. And it's not surprising that its score, while not the top score within our 500 companies, but a pretty high up score. And it's going to be very hard for us as we rebalance each quarter to have a situation where the fundamentals of Apple get so bad that they score out or get X'd out of the portfolio. It scores well on all of those criteria that I mentioned. We love Apple.
So, what are some of the flags that would make you avoid names likely to underperform?
Yeah, so it shouldn't surprise you that companies like retailers or utilities or real estate companies or energy companies, even of late, have poor metrics under our scoring system. They're just not growing their businesses. They're not hiring a lot of people. The management teams are in a tough position because to say that they can address technological change when a lot of the basis for the businesses that those companies represent, it's pretty hard to be able to address it and to make significant change that's going to start to improve those companies' growth metrics. So those are the kinds of industries that naturally you would think would get X'd out. But communication companies are also challenged. AT&T, Verizon, those are just the highly levered, not growing businesses, and they've been challenged under our scoring system and have been perennial X-outers, as I like to say.
So, any technology has the potential to be disruptive. Can you cite some that stand out from the others?
Yeah, I mean, we believed when we launched this, and we launched the index in July of 2019, that technological change was going to continue to occur and accelerate its occurrence in impacting other businesses. What we didn't anticipate was that there would be a pandemic. And the pandemic identified and accelerated for all of us exactly the answer to your question, right? Let's think about virtual work environments. You and I are being interviewed with each other by camera over Zoom. In
Mhm.
the past, whenever I got interviewed by folks like you, I'd have to physically get up, drive to the studio, I'd get makeup, I get myself all prettied up for your interview, and we'd have our short interview, and then I'd leave. It took me twice as long to get home. Think about how
Mhm.
efficient we've become, and companies that are participating in this, both as the providers. There's a vendor we're both using right now to communicate with each other, but there are also providers that are facilitating this, and businesses are taking advantage of it, and they're becoming so much more efficient. Think about how efficient you and I can be right now. And so I'd say that acceleration that the pandemic created is impacting everyone at just a much faster pace. So I'm just using that as one example in response to your question. Thousands.
Okay, so how big of a risk do you view interest rates and inflation as we move forward?
Yeah, this is a fun question for me because I think the biggest risk that all investors are facing is technological change. And we spend all of our time, the media, the financial media especially, talking about interest rates, every movement, trying to anticipate every movement, why it's moving this way, what's happening to the bond market, what happened to the bond market last week, what's going on right now. It's driving stock market decisions because of what's happening in the bond market, because of what's happening in interest rates. Hogwash. Let's focus on the most important thing that's changing our lives, technology. Every day something new comes into our lives that makes our lives better, that helps us to address some of the challenges that we have. And it's vastly more significant than interest rates. So I'd like to try and get us to have every morning's talk shows on financials be about what's today's technology risk. And let's change the paradigm of the way people are thinking, because our heads, as we've seen in the pandemic, are not fully grasping the significance of this and how it's going to change them. So I hope that's a good non-answer to your question.
Yeah, it was great. Okay, so last question here. What areas are you looking at for your next ETFs?
Yeah, so we think what we're doing with the large cap US equity market can be done across many other indices. And if you recall, my first insight was flows are continuing to indices. So the next one that I'm working on attacking right now is the mid cap index. We think that is a great growth area. There are a lot of fabulous companies that has significantly different dynamics than the US large cap, because the US large cap is dominated by mega caps, as you know. We talked about Apple. The top 10 names in the large cap universe are overwhelming. In the mid cap space, that's not the case. Those top 10 names by market cap are not that dominant in terms of the percentage of the overall index. So we think it's very exploitable. We think there are in the 400 names in the mid cap index, 200 not good ones, 200, and it's much easier for me to identify for you what the 200 lousy ones are than to try and figure out what the top 10 best ones are.
Mm-hmm. And then X them out.
X them out, exactly.
Awesome. All right. Well, thank you so much for joining us on the show today, David.
It was great to be here. Thank you so much for inviting me.